Welcome. Welcome everyone to our Tax Basics webinar for freelancers. For those who have been to our webinars before, you'll be familiar with the layout. Essentially, we'll run through the sort of a few slides, give you a bit of background and a bit of information, sort of tax necessary information. And we'll close the session with an open Q&A session where you can ask your tax questions and which we will try to answer, well, at least as many as we can. If I can ask everyone to put the questions in the Q&A section of the webinar rather than the chat, it's just easier for us to then keep track and keep an eye on what's coming in. And let's leave chat for more technical questions or just chat, right? I think that's it. So before we start going into the meaty bit of tax, I'll briefly introduce TaxScouts. Essentially, we're an online provider of personal tax return services, where a certified accountant completes and files your tax return for you for a single fee of £119. As I said, it's an online service. Few simple steps. All you really need to do is answer a few questions, follow a few steps, and we do the rest. More recently, we also launched a tax advice service, so feel free to visit our website and chat our lovely support team online as well if you have any questions or just to browse around. The next slide is more of a visual or an illustration of the simplicity of the service. But without further ado, I will introduce your lovely speaker of the day, Marcus. Marcus has over 14 years of experience working in personal tax. And he was actually one of the first accountants to join the TaxScouts team back in 2018, because we are a fairly new company. So we only really kickstart things in 2018. And since then, he has helped hundreds of our customers. So Marcus, I'll let you do a more thorough introduction if you so wish.
Yeah, sure.
But from this point onwards, it's over to you, really.
Thank you, Patricia. Yes, I was actually the very first accountant to join with TaxScouts, actually. So yeah, I met with the team and basically just discussed on how to make tax returns more simple, basically. It's a burden for a lot of people. So trying to make it as simple as possible. A lot of people put it off doing or try it themselves and struggle. So that's where the TaxScouts service really helps people, especially who are new to tax returns and just all things business, basically. So yeah, my name is Marcus. I have a accountancy practice based in the West Midlands called Counsel Limited. You can see the website counsel.co.uk. We complete sort of everything that you'd expect from a typical accountant, really. We do sort of personal tax, company accounting, all the bits in between, like the admin side of things most people want to try and avoid. And then one of the sort of newer things that we've started doing is sort of assessing people's needs in terms of what systems they might need to help them automate things or just process things easier. So we've started doing a bit more of that. So yeah, without delaying, let's get into what we're going to go through today. So we're going to go through sort of the essentials to start with, key dates, tax rates, why you need to pay tax, different tax and national insurances and things like that, expenses that you can claim. So, just to make sure you're claiming for all the things that you can claim for. And then what to consider for moving ahead. So we're currently in the 2021-22 tax year. So things that might crop up on that tax return. And then, as Patricia said, we'll go through some questions that you may have. So we'll hopefully be able to help you out with those.
Yeah, just for those who newly joined as well, if you can add your questions to the Q&A section of the webinar rather than the chat, just because it's easier for us to keep an eye on it and to monitor it. So any questions you have, please put them in the Q&A section.
Yeah, sure. So let's get started. So this first page is sort of key dates. The dates for tax returns are quite confusing if you're new to tax and new to business. So the tax return covers the tax year, which runs from the 6th of April to the 5th of April. So, for example, the 2020-21 tax year runs from the 6th of April 2020 to the 5th of April 2021. You have around 9 months to file a tax return. It's due by the 31st of January if you're filing online. That's also the payment date where you must make the payment by. But you can start from literally the first day of the new tax year. A lot of people think that you can't, but you can. You can file it as literally as early as the next day. And there's a sort of common misconception that once you file, that's when you need to pay. The payment deadline is still the 31st of January. Never mind when you file. You might have a few reminders come through, but that is purely because HMRC knows what figure you need to pay. So they just send reminders and hope that you sort of pay sooner. So the timeline, so we've gone through the start of the tax year and the end of the tax year. We've got the 30th of December. So quite a few self-employed people will also be employed as well. So if you do have a bit of profit from your self-employment and you have a bit of tax to pay, what you can do is on your return ask that that money due is taken from your tax code through your employment. So the sort of regulations behind that, it can't be more than £3,000, but you've got until 30th of December of each year basically to put that in your tax return to pay it through your tax code. That gets spread over the tax year through your tax code, so it doesn't all come off in one go. But that's just a nicer way to sort of pay your tax throughout the next year if you've made a bit of profit in that year. 31st of Jan, so that's the last day to submit. So you've got until literally midnight to submit it, and the payment date. So that the money that you need to pay for your tax must be sent to HMRC and in their account by the 31st of Jan. And then we're going to touch on this a little later, but payment on accounts could apply. So typically if you've got more than £1,000 to pay, you will be required to make a payment on account, which is basically a payment towards the next tax year. So HMRC expect you to make the same or similar amounts year on year. So it's like a way of paying in advance for your next tax year. But like I said, we'll touch on that in a further page. So getting organised. So there's a few sort of tips here on how to manage your finances. So tip number one is to basically keep on top of your incomings, your outgoings. A spreadsheet is fine if that's what works for you. There's quite a few apps these days that will sort of help you manage your incoming and your outgoings, that will also help you see, you know, which customers have paid you, which customers still need to pay you, and things like that as well. So I suppose it depends on how much you really want to, you know, get out of your figures, and if you just want sort of the essentials done, or if you want a bit more information, it's there for you if you need to. Storing records for 6 years. So things like your sales invoices, your purchase receipts and things like that, if they're in paper format, they need to be kept for 6 years at a minimum. If they're online in a digital copy, that's fine. But if you've actually got the paper receipt, you need to keep them sort of filed away if possible. Plan ahead for tax payments. So generally, if you know, most people that use spreadsheets or use apps to sort of manage their finances will be able to see if they're sort of you know, making a profit, and based on that, there's a few calculators available on the TaxScouts website where you can sort of estimate your tax bill. So planning ahead on saving some money towards taxes is always a good advice if possible. So it's not a sort of shock to the system if you've got tax to pay and no money in the bank to pay it. File as soon as you can. So ideally you want to file literally once you have all the information available. And this sort of ties in with the last point. Whereas some people will sort of leave it to the last minute, or not deal with a tax return and have like a few years to complete. The best advice I can sort of give is to be on top of your finances, deal with it as it comes along, and don't sort of sit on it because the situation just gets worse. You know, fines accrue and things like that. It's always best to keep on top of things, keep up to date with your filings, and basically file literally as soon as you can to know what you've got to pay, allow you more time to pay it, and things like that. So starting as a freelancer. So obviously lots of different people go into business doing different things, but I suppose the whole idea is to make a bit of profit. So paying tax on that profit happens when you go above the personal allowance figure. So the personal allowance is what you can earn tax-free per year. So at the moment, that's £12,570. So you can earn that, and you won't pay any tax on that. If you're employed on top of a self-employed job as well, you can earn up to £1,000 before you have to pay any tax on that, or file a tax return. There's a thing called a trading allowance, which is mentioned at the bottom, which is basically £1,000 of expenses you can claim towards your tax return, and you don't need to keep any receipts for that. It's just a trading allowance. It's available to everyone, and it's a real nice way of sort of testing the waters, especially if you're brand new to freelancing and things like that. And then the date to register for self-employed is the 5th of October for every year. So that's the 5th of October following the tax year. So if we said the tax year ending the 5th of April 2021, you've got until the 5th of October 2021 to register as self-employed. So I think that's next week, the deadline for that. So if you need to get registered, that's the time to do it. TaxScouts also has a service to register you as self-employed, to obtain a UTR number if you've not got one. And like I said, the link for the TaxScouts calculator is at the bottom of the page here. So I think there's quite a few calculators on there, but it's just gives you a good insight of what tax you might be paying and things like that. Or if you want to, plan ahead and do some forecasting, things like that as well.
Yeah, we have a few different calculators actually, and there's one for employed, self-employed as well, which I think might be of interest to a couple of attendees today as well, because I can see that a few people are both PAYE and self-employed. So yeah, feel free to jump on and have a browse around and play with the calculators as well.
Okay, perfect. So on to tax rates themselves. So on this page, we've got the two different sort of main taxes. One is tax and one is national insurance. So income tax to start with. So the personal allowance, £12,570. That's what you can earn. It's completely tax-free at 0%. So whatever your profit is, if it's up to that or any figure up to that level, the tax rate is 0%. Above that, from 12,571 to £50,270, you would be a basic rate taxpayer, and that's taxed at 20%. So these are your profit. This is based on profit of self-employment. Obviously, if you've got employment as well, then that is also brought into the calculation. So it's your total income. So if you've got, I don't know, let's say a £20,000 annual salary and you had a bit of self-employment profit, those two get added together, and whichever that figure totals as, that falls into one of these different tax bands, basically. The higher rate above £50,271 up to £150,000 is 40%, and then anything over £150,000 is 45%. So the other thing, class 4 national insurance. So class 4 national insurance applies to self-employed people, and I don't think it's sort of shown enough by HMRC. I think it's often overlooked. But basically, the class 4 national insurance is based on your self-employed profits. So if you earn up to 9,568 in profit, you won't have any class 4 national insurance. But anything above that, up to £50,270, the class 4 is based at 9%. So typically what we find is we've got a basic rate taxpayer at 20%, but they've also got class 4 national insurance at 9%. So anyone with a profit that falls into those figures, they're sort of paying 29% in tax and national insurance. And I feel that could be sort of explained a little more by HMRC. I think it's often overlooked, and some of the customers we deal with sort of aren't expecting the class 4 national insurance. They sort of know about the basic rate of tax, but are sort of quite surprised by the 9% on the class 4 national insurance. There is one other national insurance, which is for being self-employed, which is class 2 national insurance, and that is £3.05 per week, which is £158.60 per year, and that's just a national insurance for being self-employed. So that gets included on your tax return. I believe, sort of quite a few years ago, it used to be you'd need to make the payments, but that's just all included in the tax process now. So limited company versus self-employed. So there's not really a, this is the set route for you. It's going to depend on your situation, sometimes what you do. There's a multiple different factors to why one might be better for you than the other. But just to sort of compare the two. So a limited company has much more admin. There's quite a few more filings. There's a requirement to sort of complete annual accounts, company tax returns, and those must be in sort of a set format. Generally more expensive as well to sort of run a limited company. A company pays tax on its taxable profits. So there's a tax on profits there. Shareholders subject to tax and dividends. So if you have dividends from a limited company, the shareholder gets taxed on those depending on the different rates of how much they've had. Comparing that to a sole trader or self-employed, they literally have to complete one tax return each year. The general process of completing that is easier because it's generally just based on the tax year itself. There's some confusion sometimes with the limited company because they will have a different year-end date, and dividends and things can fall into different tax years and so on. So there's a lot more planning involved with limited companies, I would say, compared to self-employed. Self-employed is much more straightforward. You are the company as a self-employed person, whereas a limited company is a separate legal entity. So there's different sort of situations where one might be better than the other, but generally self-employed is the sort of easier route, especially if you're first starting out as new in business. So moving on to expenses and what you can claim for. So expenses, you want to basically claim as many as you can to get your profits down. So you're taxed on your profit. So the lower we can make that profit, the lower you're going to get taxed, basically. The TaxScouts website has a brilliant list of sort of different things that you may be possible to claim for and things like that. So that's well worth a look at. And again, it's going to depend on what you do, your situation and things like that, whether certain expenses will be claimable for you. Some top tips on this. So there's many different sort of apps out there for claiming expenses or just tracking expenses to be claimed. And I would definitely recommend using one because they just generally help in terms of just managing things. You can sort of scan receipts and things like that these days, which means you don't have to sort of keep the paper copies either, which is nice. One that is sort of not generally claimed is using your home as an office, which has obviously been a popular one during COVID and lockdown and things like that. So that is a set rate where you can claim to sort of use part of your home as an office. And so at the moment, the sort of top rate is £312 a year, and that can just be, that's like a HMRC approved rate. It's basically depends on how many, which rate applies to you. And then things that sort of often overlooked. So business memberships is like quite a common one that people don't claim for that they can. There's generally a saying of it must be wholly and exclusively for your business whether you can claim it. So again, like I say, it depends on different people's situations and what they do as to what they may or may not be able to claim for. So one of the big ones is a mileage expense. So if you use your personal vehicle for business use, you can claim a mileage allowance. It's generally the easiest way of doing it. So if you go to visit a client, the easiest thing to do is to sort of use your start postcode, where you're visiting postcode, work out the miles, and then obviously it doubles if it's a return journey, and then to sort of get the total mileage of that trip. The mileage allowance is 45 pence per mile for the first 10,000 miles. So 10,000 miles would be £4,500. It's generally the quickest, simplest way. And again, there's even apps for tracking mileage available these days, which split sort of personal and business use out, which is a really nice thing, and that just sort of automatically does it for you as well, which is nice. So 100% recommend looking at one of those as well. So doing your self-assessment tax returns, some things to consider. So a lot of people will obviously, try doing the tax returns themselves, which is fine, but obviously it can lead to a few problems in terms of, potentially missed expenses that they haven't claimed. There might be letters from HMRC that you're not sure of, and having an accountant there just to sort of look over the return, give you peace of mind, things like that, I always think is nice to have. So to do a tax return, you'll need a UTR number. So UTR stands for Unique Tax Reference. It's a 10-digit number. It's basically like an identifier to HMRC for you as a self-employed person. And that allows you to submit a tax return to HMRC. If you're late filing return, so if you go past the 31st of January deadline, you've got £100 fine, and that is literally a minute late can be £100 fine for not filing on time. And like I mentioned previously, if you leave it to sort of linger on, the fines unfortunately just get worse. So they can be £10 a day thereafter, and also sort of 5% of your tax bill as well. So depending on what you owe and things like that, and when you file, you could be sort of heavily hit with a big sort of late filing penalty from HMRC. So again, some top tips: give yourself plenty of time to sort of plan for your tax return. Get your files in order, and a lot of people, if they're employed, will have pay slips emailed to them these days. So maybe just keep track of them, keep them in separate folders and things like that, so they're easily accessible. Or of course you can use TaxScouts, where you just simply upload the information, and an accountant will put all the information into the tax return to send to you to review and sign off and do all the filings for you and things like that as well. So a couple of things to consider for the tax year that we're currently in, 2021-22. So payments on accounts, we've briefly mentioned this before. So if you have money to pay, which is over £1,000 generally, HMRC will sort of want a payment on account. And it's their way of collecting money for a future tax year, but it's paying in 2 dates. So the first one is by the 31st of January, and the next one is the 31st of July. So there's 2 payments. So once those 2 payments are made, that goes against your next tax return figure due. And then obviously if you've got more tax, you pay the difference. If you've got less tax to pay, you should be due a refund on what you've already paid. The sort of top tip on this one would be, if you've got differing tax years, so let's say in 2020/21 you made a decent profit, but your business has been impacted by COVID and things like that in 2021-22. If we had the information and filed it before July, that can stop you making the second payment on account. So that can be, really nice for some people if they're expecting a sort of lower tax bill, to get it filed sooner and not make that second payment on account. The self-employed income scheme support grants. So there was 5 grants in total. The first, second and third grants fell into the 2021 tax return, and the 4th and 5th grants will fall into the 21-22 tax return. So whatever figure you've received in grants, these will go onto your tax return, and they will be taxed as taxable income. Again, some people probably got a little confused with this. Unfortunately, it wasn't free money. It was just to replace the money that small businesses have lost during the time of COVID and lockdowns and things. So that will be classed as taxable income, and that will go on your tax return as income. It doesn't show as sort of turnover. It goes into a separate section, but yeah, that will be classed as taxable income. If you've overclaimed, so if you've received a grant where you probably shouldn't have, then it will be claimed back through your tax return as well. So that's worth considering if you think you may have overclaimed. So time to pay, it's a HMRC scheme that was basically set up to help you pay your tax bill. Obviously, during the time of COVID and things, it's been useful for a number of people, because the tax they had to pay, they didn't have available and things like that. So HMRC's time to pay allows you to pay your tax bill in sort of a set agreement with HMRC over a number of months, in different installments, basically. And it's just a nice way of spreading your tax return payments due to HMRC. My advice on this one would be to sort of ring the HMRC time to pay team and suggest to them what would be affordable for you. So, paying X amount over 6 months or something like that, we tend to find that having that sort of in place and putting that to them works best, rather than sort of saying to them, what can you do, sort of thing. So going to them with what works for you generally tend to find works better, and yeah, just generally helps with cash flow and things like that. So one to consider if you may be struggling at the moment with tax due and things like that. So I think we're just got one last one. So reasons to file your tax return early. So again, common misconception is you don't need to pay any earlier. It's just if you file as soon as you can, you've got more time to pay. Which, you know, you might want to spread out your payments over a certain number of months, for example. Like I say, you might get a few reminders from HMRC, but you still have the 31st of January payment deadline in place. The second one, as we mentioned before, if you've got a 31st of July payment on account, if you file between the 6th of April and 31st of July, you can sort of maybe avoid making that payment or reducing that payment if you know you've had a lower profit that year. And generally, with most accountants in the UK, the sort of tax process starts in April and gets busier and busier each month. From December to January, it's just the busiest time of year for accountants. So yeah, generally with TaxScouts, we can complete your tax return sooner because there's less people who sort of have it organised to get it ready. So yeah, hopefully that that helps. I think we're on to some questions.
One advice: don't leave it until the 30th of January. Perfect. Yeah. So over to the questions. We had a few questions. This one's a lengthier one, so bear with me. We'll go through the questions now. If you have any further questions, do drop them in the Q&A section, and we'll try to go through all of them. Question number one. This past April, I became PAYE for the company I had been freelancing for a few years. I still continue to be self-employed for my other creative business. How will this affect my tax return and my bill for the first tax return since becoming partly PAYE? I've been given quite a chunky bill for this year and unsure if I will be due a refund in the following tax year. What's the best way to go about it?
Okay, perfect. So it's a great question to start with. But so generally, if you start employment sort of during a tax year, you will be asked, you know, if you've had previous employment income and things like that before. And that's basically to figure out what tax code you should be on and things like that. So generally for someone who's self-employed and then going into employment, you know, you won't have a P45 or anything like that. So your tax return will consist of your self-employed profits and your employment income. Your employment income, I would imagine, would be taxed at with a personal allowance on there, but obviously it's worth considering that you know may potentially be used up on your self-employment profits as well. So generally most people will find that they have a tax bill to pay for that first year, and then the following tax year, the sort of, you know, if you carry on with the employment, that will carry on as normal for a whole year if you're employed for the whole year, and then the self-employed profit income will also hit your tax return at that point, which, if your employment income is taxed correctly, you should just pay tax on your profits on your self-employment income thereafter. But obviously there's the class 4 national insurance to sort of consider as well that might be applicable. So hopefully that answers that question there.
Perfect. The next one, basically, when do we file? It's kind of a confused date question, I guess. So is all tax retrospective of the year before, not the current year?
So we're currently in the 2021-22 tax year, but at the moment we're currently completing tax returns for 2020/21. So those tax returns are due by the 31st of January 2022, and then we move on to the next tax year. So once that one finishes, the deadline for that one will be the 31st of January 2023. So hopefully that answers that one.
Perfect. Another one from an anonymous attendee. What's the position when you are no longer self-employed, now employed, but due to file your last self-assessment? One would assume that there is not requirement for money on account.
Yeah, so generally when you are when you're self-employed and then you move into to employment, so your employment is taxed at source. So whenever you receive a pay slip, you'll have a sort of deductions section with tax on there. So if you're due to file your last tax return, because that's when you're finishing your self-employment, there is a section on the tax return to reduce or remove a payment on account. And you just need to put a reason why. So that would be to basically say that you're moving into full-time employment. It's all taxed at source. There's no other income, so there's no need for a payment on account.
Perfect. A UTR question from Sarah. If you missed that registry deadline in October, when do you apply for next?
So Sarah, that's a good question, but the answer is literally as soon as possible. So yeah, you just want to get registered as soon as possible. When you do register, you have to put in the date that you started self-employment. So HMRC will basically assess that date, see which date that falls into in terms of a tax year, and then we'll request you to complete a tax return for that tax year. So yeah, you may miss the deadline, but certainly deal with it as soon as possible in terms of getting registered, basically.
Perfect. An IR35 question. We always get one of those. I'd love to understand more about IR35. I'm currently freelancing for one company. I invoice outside of IR35, but I'm interested in working elsewhere through this year where it might be under IR35. How much will this complicate a tax return?
It's IR35 is a bit of a sticky area, let's say. As a whole, the easiest sort of explanation I can say is that your tax return will basically sort of include all your income types. So whether that's self-employed, employed, and then we'll look at the whole situation to give you, your overview. So it's one of I'd like to, if possible, I can send you more details on afterwards. But generally, the tax return will look at your situation as a whole. It will look at the tax year in question, and look at all the income you've had, assess what tax you've already paid, and then basically work out what tax you have to pay in the on top, if that's applicable.
Perfect. And just, I suppose, following up from that, and I'm conscious that some people might have to dash off. We will follow up with a slide deck with you in a follow-up email, and I'll also make sure to include Marcus's email in there as well. So if you have any specific questions around, or if you want to take it offline, Marcus, with the IR35, then obviously feel free to do so as well. But you will have all the links and you'll have the details as well in the follow-up emails, probably early next week. Next question. So this is to do with limited company versus sole trader. Can you give an example of when a limited company may be better than a sole trader?
Okay, sure. So generally, there can be a few situations. So I'll run through a couple if we've got time. So one, the sort of benefit of a limited company, which I sort of mentioned in the webinar. So if you're self-employed, you are the business. It might be Marcus Trading as company name. If you're a limited company, the company, as I mentioned, is a separate legal entity, and then you have limited liability in terms of that company. There's also a couple of situations where if there's sort of multiple people in one business venture, that might be beneficial as a limited company. I mean, you could do it as a sort of partnership, but a limited company, you might want to, sort of structure shares and things differently. The level of payments to yourself in terms of being a shareholder with dividends and things like that could be beneficial. If it's quite high dividends and things, and also based on your current situation. So if you're employed and you get a salary, you may not want to run another salary on top through a limited company, purely because you're paying tax on one salary, you don't want to pay tax on another, and you'd be paying sort of two lots of tax. Whereas if you didn't have an employment job, it may be beneficial to run a salary through a limited company, but again, it depends on levels of income and sort of all different things, really.
Perfect. So we had a question on expenses. What happens if you only use your home office for half of the time and rent a desk elsewhere for the other half of the time?
So the use of home office is based on how the simplified version is based on how many hours you work there per week or per month. So you'd basically work that out, see which you fall into. If you rent a desk elsewhere, you should be able to claim that through your expenses. But yeah, generally you just find out which sort of category you'd fall into, and then claim the amount for that amount of time, basically.
Yeah, the link we have in this deck as well, when we talked about home office earlier, it has a little table that sort of gives you the flat rate depending on the hours, so you can have a quick look there as well later. Right, another longer one. I have a full-time income alongside my freelance work, with tax being taken out with each payslip. How does that work? My freelance income isn't overly high and my projects are fairly sporadic, so I'm not earning loads on the side. Will I need to include those work pay slips as well as my freelance invoices, etc.? I've also not done a tax return before, so I am guessing I should be working currently on whatever I earned before 5th of April this year.
Okay, so yeah, so if you're employed, you'll get taxed at source, basically meaning that you have your gross pay, any deductions come off, so your tax and national insurance, and then you have your sort of net pay, which is what hits your bank account. On your tax return, we factor in your total employment income, any money you've made in terms of profit from self-employment, and then we deduct what tax you've paid on your pay slips. So, generally, if people are paid month by month, the last pay slip would be the March pay slip. So the tax that's paid up to the end of the tax year through your employment gets taken off, and you will pay basically the difference on what's left in terms of tax to pay. So I hope that answers all that question. In very simple terms, the tax return will look at all of your income, what tax you've already paid, and then the remainder is what's due left to pay.
I think that makes sense. Hope that answers your question. Michaela had a question around registering. I haven't fully set up my business yet. Shall I register for self-employed now, or can I do it once I'm fully set up?
I think it depends on what you mean in terms of not fully set up. In terms of registering, I would do straight away. You may not be invoicing any customers at the moment, but you may have some sort of expenses that you're incurring along the way to get set up. So registering now would be best, so you can claim those expenses, because obviously those are going to reduce down any profits basically. So I'm not 100% sure on what you mean by fully set up, but if it's in terms of you haven't started invoicing yet, I would say to register as soon as possible.
Perfect. Yeah, Michaela, if you want to clarify it at some point, feel free to do so as well. But I hope that answers your question. If I forget to keep a receipt, is there any way I can still include this as a business or expense, or do I have to let this go? Yeah, we get this one quite often, not on this chat, but in general.
So the way HMRC look at that one is basically how you can sort of prove that the expense was has it come around. So if it's like an online company, hopefully you could go back to them and sort of go back and say, could I have a receipt for this expense? If it's just something, you're out in the day and you've bought something, and there's no way back of going back to them and getting the expense, you can use the expense on your bank account that's sort of shown that you've paid for it, but it depends on what it is, how much it is, and things like that. So it depends on the situation, and whether that applies to you basically.
Perfect, thank you. So it seems the person who asked the IR35 question had dropped off when we answered it. Unfortunately, I can't see your name, but what we will do, unless Marcus, you want to answer it again, but I think what we will do, we will follow up with, we'll send you a follow-up email that will have a link to the slide deck as well, and I'll make sure to include Marcus's email address in there. So you could probably so if you drop him a line, he'll probably be able to give you a bit more of a specific answer to that. Am I right, Marcus?
Yeah, I think that would be best. I'll if you can send my email over, I'll make sure I get back to them.
Perfect. Zoe asked, is it possible to make regular monthly payments to HMRC to keep me in credit for the tax year ahead, or do I need to just save that money in a personal tax account until it's due? Thank you.
Okay, so a bit of an odd one. So if we've had it in a certain few times where people have made payments to HMRC, sometimes HMRC will see it as you've got nothing due on your account, so no money to pay, and they basically send the money back to you. So it's a bit backwards. So I personally would just recommend sort of keeping it in a separate account, and yeah, just keeping it separate. And then once you've got your tax bill and you know how much you've got to pay, I would you've got that money saved that you can send to HMRC.
As a general rule, we tend to suggest that people put 30% aside for any tax, and there's now lots of banks and things who actually have like tax pots and things specifically for these things. So it's probably best to just keep it aside so you have the money when you need it.
Exactly. Yeah. That's a lot of the sort of challenger banks that say will have the sort of saving pots and things like that. So
I think Monzo is one that has like proper tax, they call it tax pot or something like that.
Yeah.
Perfect. Can you claim your phone bill or parking tickets as part of your expenses?
Okay, so
yeah, I think I know the answer to this, but let's see.
So phone bill, if it's a completely separate phone, so if you've got, say, a personal phone and a business phone, you can claim the business phone bill amounts. If you've got one phone that covers both, generally what we say is to sort of take a percentage of your phone bill charge. So it might be, I don't know, 80% personal and 20% business, and to sort of take 20% of your total phone bill and include that as a business expense. Parking tickets is a much tougher one because it's much harder to sort of prove to HMRC that that parking was for business usage, basically. So what I would tend to suggest there is just to go with the sort of mileage allowances and use them. And generally they work out a good rate for people anyway. So yeah, the mileage covers all things sort of car expense related. So that's probably what I'd suggest there.
Perfect. And we have one last question, pretty much bang on time. Payment on account one. I suppose that's one that it's in many people's minds. I am confused about payments on account. I can't blame you, Joe. I only started freelancing in January this year, and I am about to work on my first ever tax return. Where does payment on account come in, or do I not need to worry about it until next year?
Okay, so payments on account. So if you've just got self-employed income and your total tax due is above £1,000, then you should be due to make a payment on account. So just double checking this one. So it started in January this year. So depending on your earnings and things like that, obviously you'll only have income for Jan, Feb, and March of the tax year. So depending on your income for those sort of 3 months, if your tax due is above £1,000, then you should be due to make a payment on account. So then you'd make a payment by the 31st of January towards the next tax year, and then 31st of July, which is also towards the next tax year. So those two payments would be what HMRC expect you to, due to make in terms of a tax bill for next year. So hopefully that answers that question.